Ever wondered how people really make money on the New York Stock Exchange? It's not about chasing hot tips or getting lucky. It's about having a solid plan. Today, I'm going to give you a detailed, practical guide to investing on the NYSE, from building the right mindset to executing your first trade and managing risk like a pro. Whether you're a complete beginner or looking to sharpen your skills, this is the guide you've been waiting for. First things first. Successful investing is all about planning and discipline. Before you even think about buying a stock, you need to ask yourself a few key questions. What's your goal? Is it long-term growth, a steady income from dividends, or simply preserving your capital? What's your time horizon? Are you investing for 1 year, 5 years, or the next 20? And crucially, how much risk can you stomach? Can you handle seeing your portfolio drop by 20% without panicking? Write these answers down. This isn't just a suggestion. It's your personal investment rulebook. Discipline will always beat prediction, so create a plan and stick to it. Next, let's quickly cover the basics of the NYSE. Most of the action happens during the regular U.S. market hours. This is when there's the most liquidity, meaning it's easier to buy and sell without the price jumping around too much. There are also pre-market and post-market sessions, but be careful, the spreads between buy and sell prices are wider and things can get volatile. For most investors, sticking to regular hours is the safest bet. The opening and closing auctions are also important moments where large orders get filled, which can cause significant price moves right at the start and end of the day. Now, for one of the most powerful tools you have as an investor: diversification. You've heard the saying, don't put all your eggs in one basket. This is that principle in action. A well-diversified portfolio spreads your risk across different stocks, sectors, and even asset classes like bonds. If one part of your portfolio is down, another might be up, smoothing out your returns. For a young investor with a long time horizon, you might have a portfolio that's 80% or even 90% in stocks. If you're more conservative, you might lean more towards bonds and high-quality dividend stocks. The easiest way to achieve instant diversification is with broad market index ETFs or exchange-traded funds. They're low-cost, easy to manage, and give you a piece of the entire market. So, what can you actually buy on the NYSE? You've got options. There are individual stocks, which are great if you have a strong belief in a specific company and have done your research. Then there are ETFs, which we just talked about. They are perfect for building the core of your portfolio. You can also invest in foreign companies through what are called ADRs, or American Depository Receipts. And for stability and income, you can look into bonds and preferred stocks, often available through bond ETFs. A smart strategy for many is to build the foundation of their portfolio with ETFs and then add a few individual stocks to potentially boost returns. If you decide to pick individual stocks, you need a process. Don't just buy a company because you like their products. You need to do your homework. First, look at the business quality. Is it in a growing industry? Does it have a competitive advantage, like a strong brand or network effects? Second, check its financial health. Is it making cash? How much debt does it have? Third, look at profitability. How do its profit margins and return on equity compare to its competitors? Fourth is valuation. Is the stock cheap or expensive relative to its growth prospects? Remember, a cheap stock isn't a good deal if the business is falling apart. Finally, look at the management team. Do they have a good track record? Do they own shares in the company themselves? Always document why you're buying a stock and what would make you sell it. Let's talk about the mechanics of buying and selling. Knowing your order types is crucial. A market order buys or sells a stock at the current best available price, which guarantees your order gets filled quickly but doesn't guarantee the price. A limit order, on the other hand, lets you set a specific price you're willing to pay. Your order will only execute at that price or better. For most individual investors, using limit orders is a good habit, especially for liquidity stockies, as it protects you from paying more than you intended. You can also use stop-loss orders to automatically sell a stock if it falls to a certain price, which is a key tool for managing risk. And speaking of risk, this is arguably the most important part of investing. Your ability to manage risk and size your positions correctly is your single biggest advantage. Here is a simple but powerful rule used by many professionals. Never risk more than 1% to 2% of your total portfolio on a single trade. This means if you have a $10,000 portfolio, your maximum potential loss on any one position should be no more than $200. This simple math prevents one bad decision from wiping you out. You should also set limits on how much you concentrate in one stock. For example, you might decide not to have more than 10% of your portfolio in any single company. Protecting your capital is job number one. Another thing that can silently destroy your returns is fees. Brokerage commissions, account fees, and ETF expense. Ratios might seem small, but they add up massively over time. When choosing a broker, don't just go for the one with zero commissions. Look at the whole picture. Is the broker well regulated? Do they offer good execution quality, meaning you get fair prices on your trades? What are the margin rates if you plan to borrow? What tools and research do they offer? Take the time to compare your options. It will pay off in the long run. Also, don't forget about taxes. The rules depend on where you live, but you need to understand how your gains and dividends will be taxed. If you're unsure, it's always worth consulting a tax professional. As you get more comfortable, you might explore advanced strategies like using options for hedging. But be very careful. These tools add complexity and risk. For most long-term investors, the best approach is to keep it simple. Avoid common mistakes like overtrading, putting too much money into one stock, chasing hype without a plan, and using leverage you don't understand. So, what does this look like in practice? A balanced portfolio might have 60% in stocks, maybe a mix of US and international, ETFs to 30% in bonds for stability, and 10% in cash. An aggressive growth portfolio might be 90% in stocks, with a focus on growth and small-cap ETFs. The key is to choose a mix that aligns with your goals and to rebalance it periodically, maybe once a year, to stay on track. The two biggest takeaways I want you to have are this. Protecting your capital and having a consistent process are far more important than chasing hot tips. And second, a simple strategy combined with discipline and low costs is your formula for long-term success. Thanks for watching. I hope this guide gives you the confidence to start your investment journey on the right foot. If you found this helpful, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next video. Let me know in the comments what you want to learn about next. Happy investing.